Hi everyone, Mark Lichtenfeld, Chief Income Strategist with the Oxford Club. Welcome to State of the Market. And hey, do us a favor, please subscribe. We're almost at 10,000 subscribers. We'd love to get there soon, and that way you'll never miss another State of the Market video. All right, let's get right to it. Everyone is talking about inflation these days. And in fact, we're not just talking about it, we're experiencing it. Gas prices, food prices, housing prices, pretty much all prices are rising, and some of them very, very quickly. In fact, consumer prices recently rose 4.2%, which is the most in 13 years. And with people emerging from the lockdown and the federal government spending money like Jeff Bezos on a midlife crisis bender, there's a lot of cash sloshing around chasing a very limited amount of goods and services, and that is going to increase inflation. It's going to push prices higher. Now, as an investor, you need assets that are going to at least keep pace with inflation and hopefully beat it. Now, one way to do that, and it's my favorite way, is with stocks that pay dividends, and preferably stocks that raise their dividend every year. And that way you're not only collecting income, but you're actually increasing your buying power. All right, so while there could be more ado, there will be no further. Let's get right to my top 3 plays for beating inflation. Rio Tinto, ticker symbol RIO. It's the second largest metals producer in the world, and their bread and butter is iron ore, the stuff they make bridges and buildings and other massive infrastructure projects from. Now, China is Rio Tinto's largest customer, which bodes well for the company as there's no slowdown imminent over there. Now, Rio Tinto's dividend is variable, so it does go up and down every 6 months depending on earnings and cash flow. But considering that metals prices are going nuts, for example, iron ore is up 121% over the last year. So I expect Rio's dividend to increase over the next 12 months. Now, based on the past 12 months dividend, the stock yields 6.2%. But as I said, I expect that to go higher over the next 12 months. All right, my next recommendation is NextEra Energy Partners, ticker symbol NEP. Now, there are a lot of reasons to like this stock, including that it's a pure play on renewable energy. NextEra Energy Partners has wind and solar projects all over the country, and it's a cash flow generating machine. It currently yields 3.7%, and the dividend is a return of capital, so it's tax deferred. So here's what I mean. Let's say you buy a stock for $50 and it pays a $1 dividend that is a return of capital, so it's tax deferred. When you get paid that $1 per share, you don't pay taxes on it in the year it's received. Instead, it lowers your cost basis. So your new cost basis is $49 instead of $50. After 5 years, you've received $5 per share in dividends that you have not paid taxes on. Again, because it's return of capital, so it's tax deferred. So now your cost basis is $45 instead of $50. So let's say you go to sell it at $55, you'll pay tax on capital gains of $10 because your cost basis, again, is reduced to $45 instead of the original $50. But the benefit was that you did not pay any tax on the dividends, the $5 in dividends you received over those 5 years. So if you own a stock like this for a long period of time, you don't pay any taxes on the dividends for as long as you hold it, which could be many, many years. So that could be a really, really nice benefit. Now, the other reason I like NextEra Energy Partners is it's a perpetual dividend raiser, a company that raises its dividend every single year, except in NextEra Energy Partners' case, it raises it every single quarter, and it has done so since November 2014. And in fact, in the last year, this company has raised the dividend by 14%, and management has said it's committed to raising the dividend by 12 to 15% per year over the next several years. So that should be able to keep pace and even beat inflation, even if we start to see really, really bad inflation. 12 to 15% is quite a number. All right, the last one I'm going to bet you've never heard of. This is a little-known ETF with a 3.5% yield. It's the Quadratic Interest Rate Volatility and Inflation Hedge ETF, ticker symbol IVOL. Now, we'll just call it IVOL so I don't have to keep saying the Quadratic Interest Rate Volatility and Inflation Hedge ETF. Now, IVOL combines Treasury Inflation Protected Securities, or TIPS, with options on fixed income assets. So the ETF protects against inflation, but also it protects against an increase in volatility of bonds, which can be caused by a sudden increase in interest rates or the Fed suddenly and surprisingly cutting interest rates. So as inflation picks up, IVOL should generate greater profits. And if there's a sudden jump in interest rates, IVOL will also protect you from that as well. So there you have it. 2 stocks and an ETF that should not only protect you from the ravages of inflation, but have solid yields and should actually thrive in an inflationary environment. All right, that'll do it for State of the Market this week. Be sure to check out my free e-letter, Wealthy Retirement, for more wealth and income building ideas. Just click on the link below. I'm Mark Lichtenfeld. I'll see you next week.